Hello everyone, it's Larry East with your weekly bulletin for the week of December 31st. Happy New Year and welcome to 2019. The financial markets definitely started off with fireworks this week as it was a very volatile week. If you watched any of the news regarding the financial markets, the equity markets, the stock market, one day was up sharply, the next day down sharply. It was quite a volatile week. The week ended with a very influential report, which is the unemployment report, the jobs report for the month of December. And this report also caused fireworks. This is a very closely watched report and it can cause wide swings in the markets. And this month's was no exception. The markets were expecting 184 jobs created in December. The reports released and showed 312,000 jobs created, so far exceeded all of the expectations that the market had. So that causes markets to start jumping. The unemployment rate, that did increase. That increased from 3.7 to 3.9. Now, the unemployment rate is influenced by the size of the workforce or the people looking for work. So there was a large influx of new workers, which caused that rate to increase slightly, but it's good news that people are out there and looking for work and trying to get into the labor force. An interesting tidbit I found in the details of the report were that the majority of the jobs created of that 312 were all to people over 55 years of age. Some of the younger demographics had a slight decrease in jobs created. So that was that was all 55 and older. Now, from a mortgage rate perspective, we always watch carefully. We always worry about inflation, and the unemployment report has the average hourly earnings, which is reflective of wage pressure inflation, meaning wages are increasing, that causes inflation. So that had a slight increase from November. Year over year, we're looking at about 3.2% increase in wages, which is great for workers. Definitely has a slight inflationary feel to it. The bond market did react negatively, meaning rates increased after the release. A lot of that was due to the big number of jobs created, and the equity markets, the stock markets, reacted favorably and increased very rapidly this morning. So that definitely took some of the money out of bonds, causing rates to increase. The good news is, looking at the week, rates still managed to end the week lower than when it started, and that's been the case for the past 3 weeks. So it's been a nice holiday surprise for mortgage rates as we've seen slight increases in rates over the last 3 weeks. Looking at housing news, CoreLogic released their home price index for November. So this report measures home price appreciation, and it did show home prices continue to appreciate. Now, the October report had a 5.4% home price appreciation. This is looking year over year. The November report was 5.1, so the pace of appreciation moderated slightly. CoreLogic also forecasts the following 12 months, so looking over the next year for home price appreciation, and they're expecting that at about a 4.8% rate. So they're estimating or forecasting that home prices over the next 12 months will appreciate just under 5%, which is still a nice rate of appreciation. It is showing home price appreciation moderating. This isn't prices decreasing, this is just that pace of growth slowing down to a little bit more of a sustainable rate. That's what's happening. I appreciate you guys for watching. Happy New Year. If you need anything, I'm here to help.